Hi, I'm Siuling Hui with part 9 of a video series about how your financials can help you manage and drive business success. In this video, we'll look at what you need to consider when financing business growth. Should you use debt financing? How much debt can or should a business take on? In part 8 of this series, we laid out a scenario of increased competition and the decision to undertake significant business expansion. We focus on 4 key profitability concepts: markup versus gross profit, break-even analysis, and the profit lines EBIT or earnings before interest and tax, and EBITDA or earnings before interest, tax, depreciation, and amortization. We discussed the use of EBIT and EBITDA in assessing debt service capability of the business. In this video, we'll examine the use of debt financing for business growth. And so we will now focus on the balance sheet, that's the financial position, and cash flow aspects of the business. Here are some additional assumptions about months 9 and 10 that impact our business's balance sheet and cash flow. Let's say sales stays at the same split of 80% credit terms and 20% cash terms. We'll be carrying more inventory as a result of our business growth, but we'll manage inventory levels tightly and maintain inventory turnover at around 50 days. Our supplier still provides us with 30 days credit terms and we pay on time. We have to make tax payments in October. Now let's look at what this means for our balance sheet. Let's start with an overview of the balance sheet. The balance sheet reflects the rapid business growth. Total assets have gone from just under $60,000 at the end of August to just over $95,000 at the end of October. Most of that growth is in current assets, in particular debtors and inventory. We need to look at financial ratios rather than just the raw numbers to get real insights into the financial position of the business. We've discussed liquidity ratios in part 5 of this series, so I'm only going to touch on this very briefly here. The liquidity position of the business has declined, as you can see from the current and asset test ratios. That's because of the rate of increase in current liabilities. In particular, the rate of increase in trade creditors has outpaced the increase in debtors. We are buying much more to meet sales growth. Part of those purchases are also going into higher inventory holdings. Also, not all our debtors pay us as quickly as we pay our suppliers. We'll come back to this when we look at cash flow. In this video, we are focusing on the concept of financial leverage. There are a number of definitions of leverage. 2 common ones are the ratio of total liabilities to total equity and total debt to total equity, which is known as the debt-equity ratio. Leverage, which is also known as gearing, is essentially about using other people's money to make money. It enables you to power up or multiply the buying power of equity. That's the owners or shareholders' funds invested in the business. Let's take a look at a simple example of how this works. You can think of a balance sheet as having 2 equal and opposite sides. On one side, you have assets, the stuff that the business owns. On the other side are liabilities and equity. This side shows you how the assets were paid for. In accounting, assets are always equal to the sum of liabilities and equity. The leverage ratio, total liabilities to total equity, tell you how much of other people's money, that's liabilities, that you are using to fund the business relative to what you or the shareholders of the business have put in as equity. Some of these liabilities, like trade creditors and taxes, are sources of free credit in that they haven't got interest charges associated with them as long as you pay them when due. These sources of funding are short-term. Your suppliers and the tax office are not your bankers. Likewise, you should not be bankrolling your debtors either. Debt, however, isn't free. You have to pay for the use of debt. The leverage ratio, called debt to equity, shows you how much interest-bearing debt the business has relative to equity. If you did not use other people's money to fund your business, you are either limited as to how fast you can grow your business, or you and the shareholders have to keep coming up with all the money to fund the business. Financial leverage increases the risk profile of your business. You are adding financial risks to business risks. By business risks, I'm referring to all the risks associated with operating a business. Economic or industry downturns, debtors going bad, stock going bad or becoming obsolete, and so on. Financial risks are the risks associated with the way you finance your business. On the other hand, leverage also helps you amplify the return on equity, or ROE. That's the rate of return on your investment of your own money or shareholders' funds in your business. It's the ratio of profit after tax to total equity expressed as a percentage. Note that the amplification effect works both ways. You win bigger, but you also lose bigger. Let's take a look at how leverage enables you to earn a higher level of return on your equity. Here's a summary of our existing profit and loss. Leverage on a total liabilities basis is 1.2 in August and rising. This indicates that our total liabilities, that's trade creditors, taxes, and borrowings, is increasing faster than equity. Debt to equity ratio is much lower at 0.5 in August and slightly lower by October. So debt is a relatively lower and reducing proportion of our total liabilities. And that's to be expected as we are paying off the loan each month. Return on equity dropped to 5.3% in September because of the sharp drop in margins, which wasn't sufficiently offset by sales volumes. Now, here's the summary profit and loss that has been adjusted to eliminate interest expense. Profit before tax and after tax is, of course, higher because there's no interest expense. Here's what the return on equity would look like if we had no liabilities at all. In other words, a zero leverage business. That means we have no trade creditors or debt. We pay cash for everything and we never owe the taxman any money. This is a nonsensical scenario really, because no one in their right mind would refuse trade credit terms or pay taxes before they're due to be paid. The funding for business growth is provided by the shareholders. So the paid up capital is much, much higher than in scenario A. Sure, we could put in the funds into the business by way of loans from shareholders or owners, but let's not go into a discussion about that kind of financing structure right now. Compare the return on shareholders' funds in this zero leverage scenario with our existing business, which I've labeled as scenario A. It doesn't matter that net profit after tax is slightly higher without any debt. You get less than half the rate of return on your money invested in the business if you use 100% equity financing. Retained earnings is part of equity. It's profits that belong to owners but is tied up in the business instead of being distributed to the owners. Now, let's look at a more realistic scenario. In scenario C, the business doesn't have any bank borrowings, so the debt equity ratio is 0. But it does make use of trade credit terms and also holds off paying taxes until those tax payments are due. So it is leveraged, but to a far lesser extent than in scenario A. As you can see, the total liabilities to total equity ratio in C is lower than in A. Compare the return on equity in A, where there is use of debt, and in C, where there is no debt. See how the return on equity in A is higher than in C? Now, this can go the other way if interest rates went through the roof and you had a lot of debt. That's the thing about using debt financing. It can amplify your earnings, but it can also cut the other way. This brings us to the subject of how much debt a business should have. This is a bit of a how long is a piece of string question. It depends on a lot of factors. Some of the key things to consider are the ability of the business to meet interest payments and loan repayments now and in the foreseeable future, the specific circumstances of the business, the type of industry that the business is in, the owner's or shareholder's appetite for risk, and so on. Let's look at debt service capability, starting with interest cover and debt service ratios. In part 8 of this video series, we discussed the significance of EBIT, or earnings before interest and tax, and EBITDA, or earnings before interest, tax, depreciation, and amortization. These profit numbers are used in determining the debt service capability of a business. Interest cover shows the ability of the business to meet interest payments out of earnings generated from its operating activities. Depreciation and amortization are non-cash expenses, so EBITDA works as a very rough proxy for cash earnings of a business. It is not cash flow, just a rough proxy for cash earnings. It is used in the debt service ratio, which indicates the ability of the business to pay interest and repay scheduled loan repayments. These ratios should be assessed alongside the leverage ratios. Our business has pretty healthy interest and debt service ratios and isn't particularly highly leveraged either. The amount of debt that a business should carry at any point in time should be at a level at which it still has a comfortable safety margin for meeting its interest and loan repayment obligations, even if interest rates go up or earnings go down. Note that I'm talking about the amount of debt at a point in time. That's where debt structure comes in. With a highly seasonal business, earnings will be very high in the peak season and low in the off-season. So you would not want to be carrying a lot of debt during the off-season. The prudent approach is to use short-term financing to cover the high season and pay that loan off at the end of the season. This means that leverage is high when earnings are high, but drops back down during the time of low earnings. Excessive leverage leaves a business very vulnerable in times of adversity. That's why financiers will always include covenants about leverage and debt service ratios in the loan agreements. These covenants usually require a business to cap its debt levels and to always maintain minimum debt service ratios. A breach of these ratio covenants is taken pretty seriously, as they are signs of a weakening in the financial condition of the business. Debt service ratios are based on accounting profit. Profit is not cash. It is cash flow that will ultimately determine how much debt you should take on. Let's take a look at what happened with cash flow for the recent 3 months in our story. Business growth chewed up a lot of working capital. Over 80% of our sales are on 30-day credit terms, but a number of our large customers are paying us somewhere between 30 and 60 days. We have 30-day credit terms from our supplier, and we are paying exactly on 30 days. We are also having to carry more inventory in line with higher sales. Tax payments had to be made in October. The result of all this is that cash flow from operations was not sufficient to meet interest payments and loan repayments in October. We had to dig into our bank account to cover working capital requirements and pay our loan commitments. We had capital expenditure in September, the additional computer and purchase of racking and furniture, which we funded out of cash flow. That reduced the amount of money going into our bank account in September. Our bank balance at the end of October is just under $5,000, which may be way too low to get the business through November if we keep up this pace of growth. As you can see, it doesn't matter how healthy the interest cover or debt service ratios look. Those are based on accounting profit, and profit is opinion. Cash is fact. A fast growth business is likely to have negative operating cash flow because of working capital funding requirements. So how do you deal with the debt service situation? It doesn't mean that a fast growth business cannot take on debt. Instead, what the business should do is arrange working capital financing, if appropriate, which takes us back to debt service capability based on EBIT and EBITDA numbers. If the business is making a loss at the EBIT and EBITDA lines, debt financing of growth is unlikely to be suitable. With capital expenditure decisions, the same issue of ability to repay debt also needs to be considered. These are longer-term investments, and financing is or should be of a longer-term nature as well. Can the business afford to take on debt, or should the capital expenditure be delayed? Should you use equity instead of debt? You won't know what the appropriate way of financing the business is unless you do the financial forecast. It's vital that the forecast be stress tested to see what happens to the financials under different assumptions of business performance and economic conditions. The specific characteristics of the business itself and the industry that it operates in are also things that must be considered in the financing decision. Is the business highly seasonal? Is the industry highly cyclical? For example, industries like farming and construction are highly cyclical. There will be a stretch of good years and then lean years. You can't predict how long the boom will last or how long the lean times will go on for. Where is the business in the maturity cycle? Is it a start-up or in the early stages of commercialization, or is it a stable, mature business with strong recurrent cash flows? You don't stack a startup or a business in early commercialization stages with a load of debt. The income and cash flow streams aren't certain yet. But a well-established mature business with strong cash flows can be leveraged up. That's why you see private equity doing highly leveraged deals for these types of businesses. They can afford to stack debt onto these businesses to maximize their return on investment. In essence, you need to think about the overall risk of the business. If business risks are high, like with highly cyclical businesses or startups, you don't really want to be adding on a lot of financial risks as well. But if the business risks are relatively low, then adding financial risk is not going to take the overall risk profile of the business to dangerous levels. Then there is also the individual's appetite for risk to consider. Some people are prepared to accept higher risk to achieve a higher rate of return. Others might not sleep too well at night and prefer to have less risk. The relationship between risk and return is immutable. The higher the risk, the higher the potential return. Notice I said potential, not actual. That is the possibility that you could actually lose it all. But when you win, you can win bigger. Anyone who tells you that you can expect to earn above average returns without incurring any additional risk is lying. This was the nonsense being touted by shysters flogging toxic investment products in the lead up to the global financial crisis. Let's do a quick recap of what we've covered in this training. Leverage, also known as gearing, is the extent of use of other people's money to finance your business. Use of leverage increases the risk profile of the business, but it also amplifies the return on equity, upwards as well as downwards. Two common leverage ratios are total liabilities to equity and debt to equity. There are many factors that you need to consider to determine what the sustainable debt level is for your business. Things like debt service capability, both from coverage ratios and cash flow perspectives, the characteristics of your business and your industry, personal risk appetite, and so on. Use three-way forecasts and stress test them for different scenarios to help you determine the appropriate way to finance your business. I would really appreciate your feedback on this training. Please put any questions or comments below and I will respond. If you have a specific issue or question about your business finances, you can contact me directly through my contact page. Master your cash flow, know your finances so that you can drive strong, sustainable business growth and thrive. Thank you for watching. If this has been useful, please like and subscribe to my channel.